Okay, what's up, everyone? We are continuing here with the problems. Just a few remaining, not going to take that long, right? We are looking at qualitative characteristics here. So it says the conceptual framework, right? We talked about that. The FASB conceptual framework indicates the desired fundamental and enhancing qualitative characteristics of accounting information. There's several constraints impeding these. Can you please answer each of the following questions related to these, right? So we're looking at this conceptual framework, right? There's certain items here. We're basically going to read each of these sentences and say, okay, for, let's see, 1, 2, 3, 4, 5, 6, 7, 8, which would be the appropriate box over there? What are they kind of getting at? All right, so the first one here says, which component would allow a large company to record the purchase of a $120 printer as an expense instead of capitalizing it, right? That's going to be this guy right here, right? One is going to be materiality. And really what we're getting at is like, hey, if we have a multi-million-dollar corporation, a $120 printer is not going to rise to the level where we need to put that necessarily on the balance sheet. It's not material, okay? The next one here is we have somebody who states that there must be public confidence that the standard setting system is credible, the board members are based on merit, and we are not influenced by special interests, right? So when we talk about FASB, right, what are we getting at when we say this? Right? Well, really, we need to be neutral, right? That's what 2 is getting at, right? We need this information. We don't want to be biased or bribed or something like that on there. Okay, we have a company, they changed its revenue recognition policy. Which one of these characteristics is jeopardized, right? Well, if you start changing things, right, it's going to mess up the comparability or consistency, right? So I'm just going to put consistency on there, right? You're not consistent from one year to the next. So it's going to be hard when I look at your financial statements year over year to do that, right? It's not internal to a single business year over year. Okay, 4, how about we have a bank here. They're filing quarterly and annual financial statements. Which relevant to the timing of these, or what is relevant to the timing of these? Well, this is obvious, right? It's going to be timeliness, right? We need to make sure that when we produce financial statements and information that it's on time, right? If we need to make a decision or an investor wants to invest in the next 5 days, you got to get the information in the next 5 days, or her, okay? All right, in general, relevant information possesses which qualities, right? Well, we're going to be talking about relevance, right? So there's going to be predictive and confirmatory value, and all of that needs to be material, okay? We need to care about it. So I'm just going to put predictive and confirmatory, and overall, right, it has to be material, rise to the level that we care about it. How about 6, right? When is there an agreement, or when there is agreement between a measure or description and the phenomenon it purports to represent? Information presents what type of characteristic? Well, for 6 here, right, it's going to be faithful representation, right? If the real world is like displaying this and that, we're capturing that as best we can. It's faithfully represented, okay? There's no kind of discrepancy there. 7, right, we have a person who's evaluating 2 companies, right? Which characteristic does the information they'll be using possess, right? So if we're trying to compare 2 different companies, right, the information that matters is comparability, right? If we want to invest in, Apple or Amazon, we can pick up both of them, and because they both follow GAAP in this conceptual framework, we can make a meaningful comparison on there. All right, finally, 8, a company should disclose information only if the perceived benefits of the disclosure exceed the costs of providing the information. Which constraint, right, that's going to be this guy down here, right? The cost effectiveness constraint, or just the cost benefit, right? In other words, yes, we want to provide the best information possible, but, there is cost constraints. We can't be spending millions and millions of dollars on, I don't know, an account balance that has $100 on there. So it needs to be reasonable on here. That's the overall constraint. Okay, right, we've talked about that kind of conceptual framework. Let's go over here, right? They now give us, for each of the items listed below, identify the appropriate financial statement element or elements. So some of them will just use one, others will use multiple. All right, we talked about these financial statement elements. They're kind of like the building blocks of the financial statements. So let's look at this and kind of see what happens, right? The first one here says a present obligation to transfer cash, right? Well, that's going to be a liability, right? On there. Yeah, I mixed up the letters there, no big deal. In any event, right, that's going to be that. It's what we owe, right, at a very simple level. How about dividends paid by a corporation to its shareholders, right? This is going to be, right, so we did liabilities. This one's going to be distributions to owners. That makes sense, right? If you're an owner and we distribute the profits to you, that's going to be a dividend. How about inflow of an asset from providing a good or service? This is going to be revenue, right? Really, revenues are really associated with the fundamental reason we're a business. We give the goods or services, we earn the revenue. How about the financial position of the company, right? That's a fancy way of saying the balance sheet, which the elements that are on there are your assets, your liabilities, and your stockholders' equity. How about an increase in equity during a period from non-owner transactions? We will learn about this, but this is considered comprehensive income. It's a broader view of income. We'll look at that in the income statement chapter. How about increases in equity not resulting from revenues or investments by owners on there? So for 6, right, that's just going to be a gain. Difference between a revenue and a gain. The idea with that is a gain is kind of a secondary transaction. It's not really the fundamental reason we're a business. Maybe we made some money in the stock market, right? If we think of, I don't know, Pizza Hut or something, or a cookie company, they make their money from selling pizzas or cookies, right? Not necessarily the stock market or something like that. All right, how about 7, sale of an asset used in the operations of a business for less than its book value, right? So if it's book value, what we're carrying it for is 100, right? The cost minus the accumulated depreciation, and we sell it for 60, right? There's the sales price. The difference in that is going to be a 40 loss, right? So that will be a loss on there. How about 8? The owner's residual interest in the assets of the company, right? That's going to be the equity, right? The shareholder or the stockholder's equity. 9, a present right to an economic benefit. That's a fancy way of saying an asset, something our company owns. 10, revenues plus gains, less expenses and losses. That's just a very condensed version of net income, right? It gets us to the bottom line on our income statement. How about an owner's contribution of cash in exchange for ownership shares? That's just a way of saying an investment by an owner. All right, that's this guy right here. And then finally, outflow of an asset related to the production of the revenue. That's kind of that matching principle. We're really talking about expenses, right? And again, there's a difference between a loss and an expense. All right, so that's 1/6. Nothing too bad there. Let's wrap this up with some multiple choice, right? One thing with accounting that I would tell you to do, yes, it's one thing to see it in a PowerPoint. It's one thing to see it in a video, but accounting is not learned. You're not going to be able to just like review the PowerPoint and be good for the exam. You really learn accounting by rolling up your sleeves and doing problem over problem over problem. So feel free, right, to go and connect and look at the optional multiple choice questions and the optional problems, especially the MCQs, because like sometimes you need to see how this stuff is tested in multiple choice format to kind of get a feel for it. All right, so we have just some multiple choice questions here. The first one is the primary objective of financial reporting. right? This is going to be B, right? We're trying to provide useful information to external users, namely investors, lenders, and creditors. All right, 2, statements of financial accounting concepts issued by the FASB, right? These are going to be D, right? They identify the conceptual framework within which accounting standards are deployed. How about 3, right? In general, revenue is recognized when, right? Well, this is going to be C, right? A good or service has been delivered to a customer. In other words, we have earned the revenue, not necessarily when we get the cash. All right, for 4, in depreciating the cost of an asset, accountants are most concerned with, this is going to be D, right? Recognizing the expense in the appropriate period, right? If we buy a house or a machine or a building, right, you do not immediately expense that up front. Instead, you capitalize it, right? i.e. put on the balance sheet. And then, I don't know, say we spend $100,000 on this building and it's going to last 10 years, right? Every year we would take depreciation expense on it. So you kind of defer the expense, and it's under the matching principle, right? Because as we use that building to help generate revenue, right? Maybe it's our cookie factory or whatever, then we will match those revenues with the expense for the building, namely depreciation expense. All right, 5, it says the primary objective of expense recognition, this one's going to be B, right? Record expenses in a period that relate to the revenue. So we just kind of talked about that, for example, with depreciation. And again, our rule is going to be when we incur the expense. Finally, here it says the economic entity assumption states that in the absence of contrary evidence, all entities will survive indefinitely. This one's going to be false, right? It's not the economic entity assumption that indicates that. Instead, it's going to be the going concern assumption. It basically just says, hey, unless we have some type of compelling or reasonable evidence to tell us that the business is going to be bankrupt or go out of business, we will just make the assumption that the business will continue to operate into the future. Okay, that's it for Chapter 1 problems. Pretty easy here, pretty straightforward. We're going to end the video at this point.